we do look for 2 cuts this year, July and September, and possibly 1 in the middle of next year. What's going to be very interesting is the market's pricing in that and a little bit more over 1 year. In the next 6 months, it's already pricing in 3 rate cuts because this has been telegraphed clearly. But what's interesting is, you know, in your preamble, you were saying markets are at all-time highs and this is being done. Clearly, they're taking insurance out against uncertainties. And we compare this with 1995. 1995, we had 300 basis points of rate rises ahead of that. We had a mid-cycle slowdown. Inflation, crucially, was well, you know, within range like now. And that meant that gave the Fed the freedom to cut rates. And, you know, this is unprecedented. We have a sub 4% unemployment rate and they're able to cut rates. And that's what's different about this cycle. So what's really clear is Chair Powell is interested, obviously, in extending the cycle, and that's what he's doing.
The economic cycle or the market cycle? I got to ask. Both.
Good question. They're intertwined. I mean, financial conditions have already loosened since, obviously, they started speaking to the market since January when they already came out and started moving to a more dovish stance. And that's been key, obviously, because we're in a 2-tier economy right now globally. As you know, the manufacturing stats are very, you know, very lackluster, 7-year lows in manufacturing globally. But then we have 49-year lows in unemployment in the U.S. or 11-year lows in Europe.
Still there, you know, in great shape, and not just in the States, but elsewhere in the world as well. I mean, what would it take to actually turn that around, to move more into a recessionary environment? Yeah,
you would either need a couple of things. You need the trade talks and trade tensions to get much worse, and the market expects additional tariffs, perhaps, you know, that come out. That's not our base case. We think the concurrent truce will last till later in the year, and it'll extend, but no additional tariffs at this point. That would be a negative point, and/or a policy error from the central banks, perhaps either cutting too much or cutting too little in hindsight. But what's clear is they've been preemptive. So the bigger risk is if there's an inflation scare later in the cycle because of all this easing.
So interesting. We had a guest earlier this morning who was saying, look, U.S. China, they're going to come to terms. It's going to be a while, maybe Q1 of next year because of election cycle timing. But for second half, 2H, which we're already in, the thing to watch might be for whether or not the U.S. turns its trade tension, tariff tension onto Europe. Do you think they will? 1, and B, is that priced?
Yeah, you know, we've had various things on autos and things that have been spoken about in the market, and it's been deferred, and they're still talking. So it could shift, but that on of itself, just that sector, of course, important to Germany and certain sectors in Europe, wouldn't be as disruptive as a U.S.-China. But we have to be getting ourselves conditioned that trade issues are going to be ramping up globally. We've seen that in other parts of the world.
Korea, Japan.
Yeah.
Yep.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.